As REITs will be investing into rent-yielding commercial assets, we thought this is the time to do a check of India's office market. The commercial market is all set to bounce back. After hitting rock bottom, its prospects have started improving with the uptick in the economy, new government initiatives and improved sentiment. Manasi Gilani reports the commercial market may achieve a 180-degree turnaround over the next 3 years.
The commercial property market is finally seeing the traction after 3 years. Recent policy decisions and efforts to improve access to finances have excited developers and investors. Sensing opportunities, many investors opened up their purses ahead of the elections. According to Cushman & Wakefield's latest research, net office absorption recorded a 16% increase at 13.4 million square feet across the top 8 cities in the first half of 2014, compared to a year ago, despite a fall in supplies by almost 7%.
I see at least the commercial market, which was just not moving, will be the area where a lot of movement will happen. And if you see the bond market, which is now allowed in commercial real estate, and the REIT market, which is also opened up, presumably next budget it will open up even further, will help a lot of developers to increase their supply on the commercial real estate side, and absorption will happen. People will make sure that their assets are occupied.
The year which has gone by has been tough. Of course, things are looking up slightly better since last 3 to 6 months, and that of course is visible. In terms of increased inquiries, there are increased inquiries. Vacancies are getting filled up faster.
The uptick has been across top metro cities, but Mumbai, according to Collier's research, saw few mid-sized deals conclude in central and western suburbs and Navi Mumbai. Construction activities remain slow in Mumbai, and no phases of projects were complete this quarter. More than 7.5 million square feet of Grade A commercial office space was available for fit-out during the surveyed quarter, of which 80% was concentrated in micro-markets like Andheri East, Lower Parel, BKC and Thane. Rents and capital values for Grade A office space remain stable in all micro-markets. In Bangalore, IT and ITES remain the primary demand driver, contributing approximately 80% in total absorption of 3.8 million square feet. This includes approximately 1.7 million square feet of pre-commitment deals from companies like IBM, Ericsson and Hindustan Coca-Cola Beverages for expansion purposes. Enthused by this demand, a number of developers launched additional towers in their existing projects, including Divya Shri Technopolis Block D, Mantri Cornerstone Block B, RMZ Eco World Tower 4A and 4B, etc. And all these projects together will add over 4.8 million square feet of office space to the city's inventory by the end of 2015. Rentals also rose moderately. Delhi witnessed improved demand as office absorption nearly doubled this quarter, amounting to approximately 0.3 million square feet. About 60% of this absorption is contributed by large office space occupiers such as Mozartbeh, Snapdeal and VFS Global. Balance leases were small office spaces occupied by corporate offices of BFSI, airlines, real estate and media companies. The city added about 0.8 million square feet of new Grade A office supply. Rentals, however, remain unaltered. Collier's outlook for the leasing market across Chennai over the next 9 months is more positive than the previous 2 quarters. The business is expected to rise of the IT/ITES tenants who make up for the bulk of tenants in Chennai. Prime office properties in Chennai are located in 4 principal sub-markets: the CBD, the IT corridor, the SBD and PBD. SBD comprises of Gindi, Manapakkam, Velachery and other areas. The PBD primarily includes Amabattur and GST Road, while the IT corridor is the old Mahabalipuram Road, the OMR in South Chennai. Rentals continue to remain low and unchanged. While demand is expected to remain buoyant for the second half of the year, any uptick in the rentals will be largely subdued.
demand could go up by 10 to 15% for both IT as well as commercial space, especially because IT companies are doing well, US markets are doing well, IT companies are hiring. In terms of rental, I think rentals could remain flat in some of the micro markets, or they could go up by, I would say, 5 to 7% on a yearly basis going forward. But I must caution here that buildings which are, I would say, grade C buildings, or markets which are peripheral in nature, markets which are not supported by strong infrastructure, could still struggle.
But subdued rentals will not hinder supply coming into the market. In fact, experts expect further unlocking of supplies as large developers look to deleverage themselves using REITs. This would bring in more investors and many HNIs, since the minimum investment is pegged at 2 lakhs.
Developers, predominant developers who have been in the commercial space would have at least 30% of their asset portfolio in the commercial real estate, and this would only increase because of the REIT coming in. A lot of developers would focus on, because that's the best way of exiting those assets.
Right now 2 lakhs norm is fine because the product is going to come first time. There's no reason for everybody to kind of jump in, and 2 lakhs is not really very high, considering that now investment limit for AIF product is about 1 CR. So while the investment limit for AIF product is 1 CR, 2 lakhs is, I think, just fine. And people with some knowledge, some information should come in.
REITs is expected to channelize nearly $20 billion into the real estate sector in the next 3 years. This could well be a major game changer. An upswing in commercial property demand will only help things fall in place for the real estate sector as a whole. In Mumbai, Anasi Gilani.
On that note, we're going to a short break. On the other side, we travel to Awadhi, a Chennai suburb. It's fast emerging as a hub for low-cost housing, and it's from here